Hey everyone, welcome back to Corporate Decoder, where we shine a light on the hidden stories within corporate filings. So this latest filing, let's just say it's got more drama than a season finale. Today we're diving into a report from Movano Inc. Now, Movano is a company that has been trying to make waves in the wearables and health tech space, a pretty competitive arena. They're aiming to bring advanced health monitoring right to your wrist, a big promise if they can deliver. But as we all know, the path to innovation is often paved with financial hurdles. And that is exactly what this filing is all about. The main event here is a notice from the Nasdaq stock market, or Nasdaq as we all call it, telling Movano that they're not playing by some of Nasdaq's rules for staying listed. Think of it like a company's report card, and this one's got a few Fs. Specifically, Nasdaq is flagging that Movano isn't meeting a requirement to have a certain amount of stockholders' equity. Stockholders' equity is like the company's net worth what's left over if you sold all its assets and paid off all its debts. This isn't just a friendly suggestion though. Nasdaq has rules to make sure companies that trade on their exchange are financially stable and not likely to just vanish. This particular rule they're talking about, called the stockholders' equity requirement, says listed companies need at least $2.5 million in their net worth. And in their last financial report for the period ending the 30th of June, Movano reported only about $1.6 million in stockholders' equity. So yeah, they're a bit short. Now, this isn't their first rodeo with Nasdaq keeping a close eye on them. Previously, they were also in hot water for not filing their financial reports on time. Remember that big worry about companies missing deadlines? Well, it seems like Movano was one of them, but they've since filed those missing reports, so they've cleared that hurdle. They also had to meet a minimum bid price requirement essentially. Their stock price needed to stay above $1. To help with that, they've gotten the green light from their shareholders to do a reverse stock split. This is where they basically reduce the number of outstanding shares to try and bump up the price. Per S hair, it's like cutting a pizza into fewer slices, so each slice looks bigger. They're planning to do this sometime before the 30th of October of this year to make sure they meet that $1 per share rule. The hope is this will keep their stock trading on Nasdaq. However, this new notice about their stockholders' equity puts them back on thin ice. Nasdaq is giving them until the 8th of October to present their case, basically to explain what they're going to do about this shortfall. They intend to present a written plan to Nasdaq. But there is no guarantee Nasdaq will accept their plan, or even give them more time to fix it. This whole situation will be reviewed by the Nasdaq hearings panel. So Movano is in a critical period right now. They need to convince Nasdaq that they have a solid plan to not just meet the current requirements, but also stay compliant in the future. It's a high-stakes game of financial Tetris, trying to fit all the pieces of compliance into place. Now, I know we all love to look at the juicy numbers, but this filing is less about a deep dive into a detailed financial statement and more about a critical juncture in the company, S-listing status. The key financial takeaway is that stockholders' equity of approximately $1.637 million. This number is starkly below the $2,500,000 minimum required. This is just a minor dip. It is a significant gap that indicates the company's overall financial health, as measured by its net worth, is not meeting the exchange standards for continued listing. The fact that their common stock trading under the symbol MOV on the Nasdaq stock market LLC is even at risk of delisting carries significant consequences. If a company is delisted, its shares typically become much harder to trade, often moving to over-the-counter markets with less liquidity and transparency. For investors, this can make their shares significantly less valuable and harder to sell. It's also worth noting that Movano identifies as an emerging growth company. This status gives them certain regulatory accommodations, like not having to adhere to the same strict accounting standards for as long as larger, more established companies. However, even with these accommodations, they still have to meet basic listing requirements, like the one they're currently struggling with. This suggests that while they may be growing, they are not yet in a position of robust financial stability. The filing includes the standard cautionary language about forward-looking statements. This is basically the company saying, hey, we're making predictions about the future, but things could change, so don't sue us if they don't happen exactly as planned. They're talking about their expected communications with Nasdaq and their plans to get back on track. They acknowledge that actual results could be materially different due to risks like Nasdaq not accepting their compliance plan, or their inability to actually fix these financial issues. And finally, the report is signed by Jay Kogan, Chief Financial Officer. This is the person ultimately responsible for the company's financial reporting and strategy. Their signature on this report signifies that the company is acknowledging these issues and the steps they plan to take. So here is the breakdown from my perspective. Movano Inc. is in a precarious situation. They've shown they can technically address certain compliance issues like late filings, but the core problem of insufficient equity is a deeper financial challenge. A reverse stock split is a cosmetic fix for the bid price, but it doesn't magically create more equity. The real challenge for Movano is demonstrating to Nasdaq, and more importantly to the market, that they have a sustainable business model that will generate the financial strength needed not only to meet listing requirements, but to thrive. The risks are clear. Continued non-compliance could lead to delisting, severely impacting investor value and the company's ability to raise capital. The opportunity, however, lies in their health tech innovation. If they can stabilize their financial footing, they need a clear path to profitability and a way to significantly boost their equity. Without that, this filing is less a report and more a warning sign. Alright, that is our breakdown of Movano Inc.'s latest filing. What's your take on their chances of staying listed? Do you think their health tech vision can overcome these financial hurdles? Drop your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into the world of corporate finance. And don't forget to join our growing community on Discord. The link is in the description. Thanks for watching, and we'll see you in the next one.